When it comes to investing in the stock market, there is a not so popular piece of advice. Inactivity is the best way to make money as an investor. It might seem a bit strange, but the reason behind it is the huge impact that taxes can have over the long term. In this video, we will explore how taxes can significantly reduce your profits even if you make the same returns in 3 different situations. The first is if you trade frequently in the short term. The second is if you trade over the long term. And the third is if you are a passive investor, meaning you buy your investment and just hang on to it. Using a very simple example, we will compare the money you end up with after taxes in each of these scenarios. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running. So if you find this video helpful, then show your support by liking and subscribing to the channel. Let us start by looking at the profit and taxes for the simplest and most boring investment strategy, buying and holding your investment for 30 years. Imagine you put $100,000 into a passive S&P 500 index ETF like WOO and just let it sit for 3 decades without making any changes. With a 10% rate of return, your $100,000 would grow to about $1.75 million. In this video, we will assume you are in the middle income bracket, which will make your long-term capital gains tax rate 15%. So, when you sell your investment after 30 years, you will pay a 15% tax on the gains of $1.65 million. To calculate the gains, we subtracted the $100,000 from the final amount. At this tax rate, you will end up paying $250,000 in taxes, leaving you with $1.5 million. So, in this passive scenario of just holding on to your investment, you will pay $0.25 million in taxes, and what you are left with is $1.5 million as the final amount. Now let us discuss the second scenario, that is being a long-term trader, meaning you hold on to your investment for at least 365 days before selling. In this situation, you'll only face long-term capital gains tax on your profitable trades. To illustrate the impact of taxes, we will assume your performance exactly matches that of the index, that is 10% returns every year over the long term. However, research shows that many people who trade stocks, even highly qualified and well-paid fund managers, often perform worse than the stock market index, like the S&P 500. But for this analysis, we will make a more optimistic returns assumption for a long-term trader. Now let us say you book profits at the end of each year for 30 years and reinvest both the principal and post-tax profit back into the stock market. With a 15% capital gains tax, you will pay 15% taxes on your 10% long-term gains each year. This reduces your effective returns from 10% to 8.5%. And at 8.5% compounded rate of return, your initial investment of $100,000 will grow to $1.1 million at the end of 30 years. Compared to the passive investing strategy we discussed earlier, you have generated $400,000 less in returns by being a long-term stock trader. So being a long-term stock trader has cost you $400,000 or almost 400% of your initial investment amount. Now let us discuss the third scenario, that is being a short-term trader. Here we'll assume you sell your portfolio on the 364th day of each year to incur short-term capital gains tax. Short-term stock traders often lose money or have poor returns compared to the S&P 500 index. But for our example, let us say your returns as a short-term trader matches that of the index, that is 10%. Short-term capital gains tax is higher than the corresponding long-term capital gains tax. For someone in the middle income bracket, the short-term capital gains tax is 24%. So due to the 24% taxes on your 10% returns each year, your effective rate of return drops from 10% to 7.6%. And with a 7.6% rate of return, your initial $100,000 will grow to about $0.9 million. That is nearly $600,000 lower than the passive investing strategy and $200,000 lower than the long-term trader. In summary, for the same rate of return, a long-term trader generates 400% less returns than a passive investor, and a short-term stock trader generates almost 600% less returns than a passive investor. An interesting fact is that the long-term trader needs to achieve 15% higher returns than the index just to match the passive investor's return. The short-term trader, on the other hand, has to generate 24% higher returns than the index to match the annual returns of the passive investor. Achieving these higher returns is a tough task, even for the most well-paid and highly qualified fund managers. So the key takeaway is that being a passive long-term investor in an index ETF is the easiest and highly probable way to outperform most traders in the market.